Thank you to everyone for coming out today. We're excited to share some great information with you, but we have a lot of it to share. So I'd like to ask if you could hold any questions to the end. Myself and all the other staff members will stick around to answer any questions that you might have one-on-one, but I don't know if we're going to have time to get to any others today. So a brief overview of what we're going to talk about today. We're going to talk about what happened in markets last year in the economy for 2019. Then we're going to look at 2020 and kind of some things we're thinking about and doing kind of coming into this year. Jacqueline Jackson, our portfolio manager, she's going to come up and talk to you about environmental, social, and governance investing. We're going to have some financial planning updates. We've had just a ton of new information the last couple of years in the financial planning area, so we thought it important to give Nick Deffenthaler some time to talk about that and the new Secure Act. And then Nick Boguth is going to come up at the end and just give you a little quick update as to what's new in our client portal. So let's jump in. Some of the slides that are a little bit more busy, we've printed out and put on your table, so if you can't see it really well up here, don't worry, they're there and you can refer to them. We've got last year was a good year in the markets. The S&P was up well over 31%. And along with the international markets, U.S. small company stocks, they had a great year as well. And even bonds with the Barclays U.S. Aggregate Bond Index was up almost 9%. So there was a lot happening. And just thinking about like how we ended up the decade, the 2010s, we didn't have a single day of recession in that decade. And that's pretty crazy because that hasn't happened since the 1850s. So it was a really good decade, a strong end to a strong decade. So let's talk a little bit about why last year was so great in the markets. We had action by the Federal Reserve. So a year ago when I was standing here, we were talking about how much the Federal Reserve had increased rates through 2018, 4 separate times. Well, in 2019, markets anticipated more of the same coming into the year, but the Federal Reserve actually did a complete about-face and started reducing rates throughout 2019. So that reduction in rates gave a nice kind of natural tailwind to stocks and bonds alike. So we also had something called a trade war going on. That created quite a bit of volatility throughout the year at different times, but towards the end of the year, U.S. and China kind of came to a phase 1 kind of initial deal that they signed into place in January of this year. And when it looked like that was going to happen, markets responded very positively to that. And that's really just because it removed a lot of the uncertainty out there. It rolled back some of the tariffs that were in place already, and it basically allowed the tariffs that were going to happen in mid-December to not happen. So the markets responded pretty favorably to that. Then we had corporate tax cuts and stock buybacks. So if you remember the tax relief that we had a couple of years ago, one of the caveats is that corporations got a tax cut, so their tax rate went down that they pay. And that was really just to get our corporations more in line with corporations around the world and the tax rates they pay around the world. But then we also had this one-time incentive to bring money back into the country. So companies that were global in nature had money kind of trapped in their operations overseas. They couldn't bring it back without paying a pretty hefty tax to do so. And the government gave them kind of a one-time tax relief to bring that money back into the country. So that we saw that happening. So corporations were already pretty cash heavy, and that added even more to the pot. So we started to see things like M&A activity pick up, mergers and acquisitions, a lot of capital investment, but we really especially saw companies buying back their own stock. So that created kind of a natural tailwind as well for stocks. And then we have a strong consumer. I mean, you and I out there spending, we're wealthy right now as compared to history, and we're out there, we're spending money. I have some slides on that later that I want to go into in a little bit more detail though, so we'll come back to that topic. And then, of course, we had the impeachment. So that was kind of one negative draw to the market. When it looked like that was going to happen, that was some headline risk there for the markets. So we saw a little bit of volatility initially out of the markets, but it didn't last too long. I think the markets started to realize that the votes were going to go right down party lines, which they did. So the House, being Democrat controlled, they did vote to impeach as expected. And then, the articles of impeachment were delivered to the Senate, and I think we actually get our vote today from the Senate. It's very much anticipated that he will not be removed from office because of this vote, so it'll kind of be left up to the voters in November. So that's what the market's expecting, and once we knew kind of what to expect there, that really didn't cause any volatility anymore for the markets. So what are some of the things that we've been doing in portfolios? I mean, it's really been a strong period in markets, so we've been able to let things run for a while, let the stocks kind of just work and create returns for portfolios. But another aspect that we have in the portfolios, we have bonds, and we have those bonds broken into a couple of different buckets. So we have this bucket that is more credit sensitive. We think about it, it's more correlated to the stock market. So if stocks are going up, that's also an area that's going to go up. But if stocks are going down, that credit sensitive, like high yield bonds, they would also go down. So it's been a great area to get a little bit of extra return out of our fixed income bucket the last decade, really. But it's kind of time to pull back on that. So we've been trimming that back and adding it kind of to that bucket of bonds that we call core fixed. And that's really more your plain vanilla fixed income, like US Treasury debt, high quality corporate debt, things that if the markets get kind of rocky or have some downside volatility, they're going to be the place where people go for safety. So that's an area that usually does well when stock markets are going down. So that's some movements we've been making in portfolios. We've also, coming into the beginning of this year, things just looked a little stretched. So after a year of 31.5% return from the S&P 500, it just looked exhausted. We have some technical indicators that we look at, and it just didn't look like the buyers were out there in force anymore, kind of creating more, upside. So we thought, it's a good time, maybe step back, do some rebalancing if you needed it, and kind of make sure portfolios are right on target to where they're supposed to be. Then one of our major topics we've been working on in the investment committee the last several years is looking at reducing the internal expenses of the holdings in portfolios. And the reason we've been able to do this is there's been a change in the marketplace over the last decade. There's a lot more available to us as far as exchange traded funds, index funds, that type of thing. They're very tradable. We've been able to watch them for a period of time and understand how they're going to work and make sure they're doing what they're supposed to be able to do. So we've been integrating more of that into portfolios where it makes sense. So if there's an area of the portfolio that it absolutely makes sense to hire a manager and pay them a little extra money to do some active management, we still utilize that. But areas where it's much tougher to beat an index, we might just add, some index exposure with an exchange traded fund that will bring down some of the costs in the portfolio. So that work over the last several years has resulted in about a 30% reduction on average in costs of the portfolio. So let's jump into 2020 and kind of how we see the economy and markets. If we didn't talk about the election, I think it'd be silly. So we have an election this year. Markets generally like the election year. One thing I want you to take away from this chart is over the last 80 or so years, usually on average, the markets are up. The S&P is up during an election year. There aren't a lot of situations where it's down. What markets don't like is uncertainty. So if you look at how do markets do in general when the incumbent party wins versus when they lose, it does better when the incumbent party wins because we don't like change in the stock market. So that's as expected. But what's interesting to see is, whether a Republican or a Democrat wins can make a big difference in that year alone. Now, if you look long term at investing, what party is in power really doesn't matter. Over the long term, markets are going to do what they're going to do. They're driven by the economy, not who's in office. So, but again, in an election year, if a Republican candidate wins, we tend to think of them as more pro-business. So the stock markets tend to respond favorably to that. And when a Democrat wins, a little bit less so, because they're more pro-social directives, that kind of thing. One thing that's really, it's difficult to do is it's difficult to predict the outcome of elections. That's not what we're here to do for you. And it's even more difficult to predict how the markets are going to react to that election. So it's kind of like threading the needle twice. So we do not generally make recommendations based on what's going on in an election. Interest rates. So last year was a very eventful year for interest rates. I think this year is going to be the opposite. I think interest rates are going to pretty much stay where they are. Maybe we'll see one more cut from the Federal Reserve this year, but I think they're generally going to stay the same. One of the things that the Federal Reserve looks at when they're making their interest rate policy decisions is inflation. And right now, inflation's right about where they want it. It's right around 2%, give or take every quarter. But that's where they like to see it. And as long as we stay kind of in a range right around 2%, we probably won't see a lot of activity from the Federal Reserve. They utilize right now a lot more words than action, although that you wouldn't think so the last couple of years, but they're really trying to drive the direction of the economy with the words they use in their press release after their meeting. So even though they may not have any action of increasing or cutting rates, the words they're using in their report is what people are looking at and what markets are often reacting to after the fact. Geopolitical risk. We started the year, this is kind of always a cloud that can come over markets, but this year we had the situation with Iran where President Trump decided to react a little harshly right at the beginning of the year. So he ended up having a missile strike that killed one of their top generals, and the markets did not like that. It was unexpected. We thought this is going to escalate into war, and it caused some volatility. But much like those headlines, they don't last very long. If we were to kind of see that come up again this year, it may. And if the economy is going into war, it's usually not bad for the economy in general, but there's that uncertainty right before things happen, and that's what markets react to. Usually if there's going to be a war, once war starts, then the markets tend to be back kind of on their way, reacting favorably, because that's, unfortunately, it's often good for the economy. Then shortly after Iran came the coronavirus, and we've been hearing about that for about 2 weeks now. It created definitely some downside volatility right at the start. A lot of that has been relieved this week with kind of a recovery in markets. And that has to do with, the mortality rate isn't quite as bad as we thought it was going to be. Governments moved pretty quickly to contain it. So, it looks like it's not on an extreme trajectory to keep growing exponentially. It looks like they've kind of gotten it under control. So that's what markets are reacting to right now. Investor sentiment is something I think that's interesting to talk about, because how we feel about the markets has a lot of impact on how the markets actually perform. It's kind of a self-fulfilling prophecy. And investors as a whole actually don't feel that strongly about markets. So there have been times in the past where there's just euphoria present with investors. And think times like 1999, if you think of, markets were going up and up and up, and everyone thought this is easy, we can make money, it's super easy. That's when it's time to be afraid. When you see skepticism out there, that's often the time when you will see positive returns from the market, because there's always kind of this wall of worry, things to worry about, that hurdles we can overcome, and that often leads to growth in markets. Last year, we were talking a little bit about a yield curve inversion, and that actually did end up happening. So when we were here last year at this time, it looked like it may happen. By summer of last year, the yield curve did actually invert. And that's when, if you recall, the 2-year Treasury is actually yielding more than the 10-year Treasury. And the reason that's bad, or that can indicate that a recession is coming, is because if you think about how do banks make money? Banks make money by lending to us at higher rates, but paying us low rates on our money market. So that difference, or that spread, is how they make money. If you have the opposite going on, and they're loaning to us at lower rates than they have to pay us in our money market, they're losing money. So they're much less willing to loan money out when rates are that low and when it's not profitable to do so. So that kind of dries up liquidity in the markets, and that is what generally will lead into a recession, and why it is a great indicator ahead of time as to what's going on. I think last year's kind of temporary inversion, it's still kind of yet to see what will happen, because after the yield curve inverts, usually you have 6 months to 2 years before a recession starts. So we're kind of about 7 months in right now. So that's definitely in the back of our minds when we're looking at our economic and our tactical indicators, is that the yield curve did invert 7 months ago. So we need to be aware that if we start to see things come apart in the economy, it could quickly lead to a recession. But I don't think that was typically a normal inversion, because they can give a lot of false signals as well. So it's not 100% guarantee that if the yield curve inverts, we're going to have a recession. You have to look at why it inverts. And I think last year it inverted because it was reacting from those 4 interest rate increases that happened in 2018. It usually takes a good 6 months or so for them to all filter into the economy, and I think that's what happened. The Fed just went too far, too fast, and it caused the inversion kind of artificially, as opposed to anything underlying in the economy. So we'll have to wait and see, but my money's on that's what happened. And I mentioned earlier the strength of the consumer, so I wanted to circle back and talk about this in a little bit more thorough way. So if you think about the economy in the US and what makes up the economy, this is a bit of a busy chart, so this is one of the ones that I have printed out in your packet. So what makes up the economy? We have government spending, of course. So governments are out there spending, they're increasing our GDP, our gross domestic product. And then you have investments, kind of outside of housing. Then you have housing, exports, imports. And then you have this biggest area, this light blue area, which is the consumer. So we are 70% of the US economy. So however the consumer is going, the economy is going. And right now the consumer is very strong. We're out there, we're spending, we're going to movies, we're buying clothes, we're buying cars, we're stimulating the economy right now. And why is that? If you look at the household debt service ratio, so this is the ratio of money we pay out every month to service our mortgage, our car payments, maybe our student loan debt. That percentage of our overall income has shrunk. So we're paying less of our income out every month in debt payments than we have in a very long time. This chart goes back to 80, and it's never been this low of a ratio. So the consumer is very strong because we're not spending as much out on debt, so we're able to save more money too. And then if you look at household net worth, that's gone up. I mean, naturally markets have gone up since 2008, 2009 timeframe, and our net worths have grown with that. But it's also, we've been able to save money. We're spending less on debt. And then this last chart that I have that I wanted to touch on really talks about, again, why the consumer is so healthy. And if you think about the gray line there is unemployment. So historically speaking, unemployment's averaged a lot higher than we are right now. We're at 3.5% unemployment rate right now. And back in my Econ 101 classes back in college, I remember the professor saying to me, when you get below 4% of unemployment in the economy, you're really employing the unemployable. People who don't really want to be working are working because there are just so many jobs and so much opportunity out there. And it's almost an unsustainable pace. So many people are working, we're getting paychecks, meaning the consumer is strong. And then on the flip side, the light blue line, you've got wage growth. So our wages over the last couple of years has taken a spike up. So we've finally started to see some wage growth coming back into the economy. People are getting raises at work, essentially. And those raises are helping to kind of lower that debt service ratio, increase our net worth, give us money to go out and spend. So that's been a big part of the consumer equation right now and why our economy in general is so healthy. Before I hand it over, I'm going to hand this over to Jacqueline. But at the end, I really just want you to remember that what we're doing in the portfolios, because markets have been stretched. It's been a really good decade. We're really just sticking to our discipline. We're doing what we tell you we're going to do. We're rebalancing your portfolios. You work with your financial planners to determine exactly how much risk you need to be taking, how much risk you're willing to be taking in the portfolio, and we're just kind of trying to keep that reined in. Because if we do have a recession, the last thing we want is for your stock portfolio to have grown to a much larger percentage of your asset allocation than you want it to be, and creating all kinds of extra risk in your portfolio that you're not expecting. So really the rebalancing is kind of the key takeaway, and what we're thinking about going into 2020 is really just making sure you have cash on hand if you need it. For your next 6 to 12 months spending. We want to make sure the cash is there, available, so that if markets are turbulent, we don't have to sell on a down day. And then we also are doing the rebalancing to keep everything in line. So I'll hand it over to Jacqueline.
All right, how was lunch? Good. Is it just me, or are those cookies like amazing? Yeah. Very good. I come here for the cookies. So my name is Jacqueline, and today I am going to talk about the Center Social Portfolios, right? And so the Center Social Portfolio is for people who want to align their values with their investment strategy. It's composed of environmental, social, and governance funds. But before I get into what that means, I first want to explain what that doesn't mean, right? Because a lot of the terminology that gets used to describe this type of strategy is often confused, and they're actually pretty different things. So I'm going to start first with socially responsible investing, right? So socially responsible investors tend to eliminate industries that don't align with their personal values. So for example, if you would like to align your investing with your religious values, you probably wouldn't have a weapons manufacturer in your portfolio, right? So that's totally eliminated from your portfolio. But the trouble with doing that is that as you eliminate things from your portfolio, you begin to eliminate different asset categories. And over time, because you don't have the diversification, your performance can erode. And the longevity of your portfolio can be compromised. So that's not the strategy that the center wanted to take, right? And so then you have your next level of social investing, which is impact investing. So as an impact investor, you're kind of taking on the role of a venture capitalist or an angel investor, right? So that means that you're actually investing your resources into a business that aligns with your values. Now, in order to pull off that strategy, you have to have a lot of capital. And the capital you use probably shouldn't be what you need for retirement, right? So that's sort of the first dilemma there. And the second dilemma is that you're taking on the risk of an entrepreneur. So we're not going to go that strategy, right? So we're landing with environmental, social, and governance funds. And the reason that we are using this strategy at the center is because it's really similar to what you're used to from a performance and risk perspective, right? And the reason it's similar is because the managers initially start out very similar to the way a traditional portfolio manager would evaluate a company, right? So they start with traditional investment analysis, but then there's that overlay of environmental, social, and governance metrics that they use to choose the companies that they're going to invest in their portfolio. Now, just to be a little clear, I'm sure you know what environmental means. That's a pretty straightforward part. For social, they just mean what is the societal outcome of business decisions. And then for governance, that doesn't have to do with government. It really has to do with corporate governance. So how is the company running, right? Does that make sense? Head nods? Yeah. So cutting corners on environmental issues, as a business, that can lead to lawsuits, fines, damages, right? If you're using less water or less power, that equals lower cost and more efficient operation for your company. And if you have good corporate governance, you treat your people well, your company's probably going to last for a long time. So to a degree, it really starts to kind of give some influence to good business, right? And I want to give you guys a practical example of that. So let's talk a little bit about emerging markets. So emerging markets are growing markets, growing economies. And because they're growing economies, they don't quite have all of the business standards of developed markets. And so you'll see that, you can see here, this chart compares an emerging markets index, so a regular emerging market index, with an emerging market index that has an ESG overlay, right? And just having that ESG overlay actually created better businesses within emerging markets. So you can see this is a 8-year period from 2008 to 2016, and pretty much every year the emerging market ESG index either did comparable or better performance than the standard emerging markets index. So to some degree, it's good business. So to wrap it up, I'm going to keep it short. I had someone in the audience who said, I'll give you your cue if you're going too long. So I'm going to wrap it up. So if you are interested in aligning your investments with your personal values, I think the Center portfolio is a good choice for you, the Center Social portfolio. But if you also think that, hey, this is kind of the future of business, it also may be a good option for you. If you're interested, we have a sign-up sheet right at the bar, and we'll reach out to you and make sure you get details about that. Also, we have a social media Earth Day campaign that's going to start in April. And so if you're looking for more information, stay on our social media and we'll give you updates that way. So with that being said, I thank you for your time and attention, and I'm going to turn the mic over to Nick Fowler to give you an important financial planning update. Thank you.
Welcome, everyone. Thanks for coming today. Nick Duffenthaler, as Jackie mentioned, and this is now the second year in a row where we were kind of caught off guard a little bit to a certain extent with a significant change in terms of financial planning. So second year in a row that I'm giving an update to everyone. Last year was on taxes. Tax Cuts and Jobs Act went into effect in 2018. So we really had a chance to kind of see how that was going to play out. Now, effective December 20th, 2019, the Secure Act went into law. Actually didn't become law and official until January 1st of this year. So that's what we're going to talk a little bit about today. The Secure Act actually passed the House in May of 2019. So it was something that was kind of discussed throughout the year. There was a few other things going on in the world and in Washington, some sort of trade issue that probably a few of you have heard about, an impeachment trial. So the proverbial can, to some extent, got kicked down the road. Fast forward to December, and got an alert on my phone that the Secure Act was going to get passed. So it was like we didn't hear about this thing for about 7 months, and then poof, there it is. The Secure Act was actually part of a bill that ultimately helped avoid a government shutdown. So I think that was kind of part of the FAST Act at the very end of the year to make sure that it went through and we didn't have to go through yet another government shutdown going into the new year. So there was actually almost 36 sections in the Secure Act. But I'll bottom line it for you. For most folks in the room, it's really only going to be 3 things that's going to potentially impact your plan. So let's kind of dive in and take a look at that. The most important, and if you're like me, you love this character, our friend here, Gumby, the death of the stretch. So an inherited IRA is one of those major things that was impacted through the Secure Act. So that's number one. That's what we're going to talk about right now. And I say the death of the stretch because for inherited IRAs, if you were inheriting that fund, or you were inheriting an account and you were a non-spouse beneficiary, you could stretch distributions over your entire lifetime. So I'll give you an example. My mom, a single woman, I'm named as her beneficiary unless I make her mad and she cuts me out. If I inherit her IRA, I could then stretch those distributions over my entire lifetime. Okay? So if she passes away before 70 and a half, she never had to take any money out. That's typically when we see required minimum distributions kick in. I would then only have to take out maybe 3 or 4% of her account value each and every year. So I could stretch those distributions out for a very, very long time. Well, the IRS, guess what? They didn't really like that idea. So they got rid of it. Somewhat of a broken promise. So that kind of stinks. We never like when the IRS kind of pulls back something that they told us that would be there, but it is what it is, and if anything, it just kind of makes financial planning nerds like us very excited to figure out good ways to help clients and kind of navigate these new changing laws. So there's a new 10-year rule. Basically what this means is if you're a non-spouse beneficiary, you have to completely deplete the inherited IRA within a 10-year period of time. Okay? So that does not mean that you have to take equal distributions each and every year. You could take everything out all in 1 year. You could take everything all out in year 10. As you might imagine, taking everything out in any one given year more than likely would not be advisable. This applies to any sort of retirement account. IRAs, Roth IRAs, 403Bs, 401Ks, anything of that sort. So for pre-tax accounts like your traditional IRAs, your traditional 401Ks, when you take money out, that's going to be completely taxable to you. Right? So if you're a beneficiary and you inherit $1 million IRA, even if you stretch out that those distributions for a 10-year period of time, still at least $100,000 a year that you're adding to your taxable income. So that's an issue. So who's exempt from that, if anyone? Spouses. So if you have your spouse named as a primary beneficiary and they inherit your IRA or 401k, Roth IRA, or whatever it may be, they could still stretch those distributions over their lifetime. Okay? If you are disabled, if you're chronically ill, you're completely exempt from this new rule. In addition to that, if you are within a 10-year age band of the primary, the original account holder, and you inherit the funds, you're exempt. So there's a couple of ways, I would say, unique situations, well maybe not so unique if you have your spouse listed, but there are certain situations where non-spouse beneficiaries could potentially be exempt from this new 10-year rule. Another exempt entity would be a charitable organization. So we'll talk a little bit about that, why that could actually make sense for some folks, depending on your goals, to actually name a charity as the beneficiary on your IRA. So some planning strategies that are on our radar. So there's really only so much that you can do with this. Okay, so how do we actually reduce IRAs over time? If we have a significant balance in our IRA, and we know that if something happened to us and we have our children listed as beneficiaries, that they're going to be thrust into a much higher bracket because now they need to essentially condense these distributions within a 10-year period of time, that creates tax planning issues. So things that are on our radar, what can we be doing now to potentially reduce those IRA or 401k assets while you're living? So things like Roth IRA conversions, things like accelerating IRA distributions throughout your lifetime, all that's going to totally depend on what tax bracket that you're in and what tax bracket you're going to be in the future, what tax bracket your kids are going to be in the future. So there's a lot of moving parts here, and we're never going to nail this. We don't have that proverbial crystal ball to see how everything's going to shake out, but we do our best to make good informed decisions and plan accordingly. The issue that at least I'm seeing right now of running into where clients say, yeah, let's take maybe a little bit more of our IRAs. That definitely makes sense. I'm actually in the 22% tax bracket right now. I want to fully maximize that because my son and daughter-in-law or whatever the situation may be, they're in the 28% tax bracket, so they're in a higher bracket. The issue though, for most retired folks, you're on Medicare. And your income that we're taking out of your IRAs is going to affect your Medicare Part B and to some extent your Part D premiums. So there are many different trickle-down effects. So we're really wrapping our arms around this and just seeing what are some great strategies to at least be looking at. We might not figure everything out in 1 year, but it's an ongoing conversation that we'll likely have with folks just to make sure that we're taking full advantage and looking at the different options that we have given the new landscape. The second, I would say, significant change, or not so significant, depending on how you want to look at it, RMD ages are now at 72, or you have to start taking RMDs, I should say, at 72 instead of 70 and a half. So you get another 18 months. Bad news, if you turn 70 and a half before the end of 2019, you don't get to skip a year or so. You're grandfathered into old law. This is only for folks who are turning 70 and a half and beyond, or I should say 70 and a half in 2020 and beyond. So that is an update. I'm not sure how big of an impact that can have if you're doing some creative tax planning, like the Roth IRA conversions that I talked about before. This could potentially give you a little bit more time before those fixed income distributions start hitting your tax return. So that could present somewhat of an opportunity, but the fact of the matter is, for most Americans, they need to live on their RMDs. I mean, it's required. You need to take it out, and it's usually around 4 to 5% of your IRA balance. And for most folks, they kind of need to live on those. Some folks don't, and that's great. So we'll talk a little bit about some ways, even more, on how to reduce those IRA assets. And one of those ways is to potentially take a look at something called a qualified charitable distribution, a QCD. We love acronyms in financial planning. So RMDs, QCDs, all these acronyms. The QCD has really become a very powerful and popular tool for clients, especially given recent tax law reform. So for most Americans, especially when you're retired, you're taking the standard deduction now. If you're over 65, I believe it's almost $27,000 now, depending on your filing status. So it's very difficult to have itemized deductions where your state and local income tax, your charitable deductions, your property taxes, your homeowner, your interest that you might be paying on your mortgage. It's really tough to kind of cross over that $26,000, $27,000 threshold. So for most folks, you're taking the standard deduction. So the QCD is a way to gift money directly from your IRAs to a charity. I probably got ahead of myself a little bit because the next slide goes into more granular detail on how the QCD functions. But something unique with the Secure Act was that even though the RMD age requirement went out to 72, you can still do QCDs if you're 70 and a half. So that's kind of unique. So you get a little bit of, I would say, a reprieve to some extent, which is something that we really like to see, because for most folks, you're not seeing if you want to just cut a check out of your checking and savings account to your favorite charity or your church or whatever the situation may be, you're likely not going to get a tax deduction for that anymore because of how much that standard deduction has gone up. Okay? So we started talking about the QCD. There are some nuances, and that's really what I wanted to focus in on today, because you really have to make sure that you do this right. It's not as straightforward or as simple as some might think. So if the check is cut incorrectly from the custodian, which obviously would be Raymond James in this situation, we could run into some issues. So let's talk about the mechanics a little bit. You have to be 70 and a half or older, as I talked about. And the nuance with this, think of the old RMD rules. you had to take RMDs in the year that you turned 70 and a half. So if you turned 70 and a half in July, you could take your RMD in January and you were good, all right? With a QCD, you actually have to wait until you're at least 70 and a half to do that. So it's not in the year that you turn 70 and a half. You have to literally be 70 and a half or older when you actually make that gift to the charity. So the QCD is essentially a way to reduce income. It's not a tax deduction. So this is going to impact your AGI, your adjusted gross income, in a favorable way. I use the term it's a roundabout way to get a tax deduction. It's actually more powerful than the tax deduction in my personal opinion, because it's going to reduce that AGI, and the AGI has trickle-down effects on things like Medicare premiums. So very beneficial strategy to look at. As I talked about, the funds have to go directly to the charity. If you have an ACH or a bank account link tied from your IRA to your local checking account that you do your banking with, and you send $20,000 from your IRA to your bank, and then you cut a check from your bank to the charity, you have lost the ability to utilize the QCD. You haven't done it properly, you've blown it up, and the IRS won't allow you to take this. So it's very important that you speak to one of your planners or your client service associate that's on your team, and we'll make darn sure that that check goes directly from your IRA to the charity of your choice, and make sure that it's cashed properly. And one thing that we've always kind of had some frustrations around, and this is not an issue with Raymond James, it's any custodian, whether it's Fidelity or Charles Schwab or TD Ameritrade, your 1099-R at the end of the year that you're going to get, that probably pretty soon, in the next week if you haven't gotten it already, that's your tax reporting document that shows how much you've taken out of your IRA, how much taxes you've withheld. I kind of like to call it your IRA's W-2 for the year to a certain extent. Well, that 1099-R doesn't show up that you did any of these QCDs. So it's on you as the taxpayer to let your tax preparer know, your CPA know, that you did a QCD. Well, it's tough to remember that as a client. We don't really expect folks to keep track of all that. So each and every year we send a letter out with the form that you signed saying how much you did for the QCD, and we mail that out to you. We say, Mr. and Mrs. Client, please make sure that you give this to your tax preparer, so that way your adjusted gross income can be reduced as much as you gifted, because we see this all the time where tax preparers miss this. And so that also kind of hammers in the importance of you giving us your tax return each and every year. So if you did do a QCD, we review your return to make sure the tax preparer did it right. And I shouldn't say the tax preparer did it right, because I'm sure they're not going to mess anything up, but it's very easy for them to miss. They wouldn't have done that intentionally, but they can only go off of the information that they have. So you have a second set of eyes, if you will, by having us review your return. So that's a big reason why we want to take a look at everyone's return to make sure that we're looking at all these different things, especially from a financial planning standpoint. Last but not least, they are not permitted in a 403B or a 401K, also known as a quote-unquote qualified retirement plan. They have to come from an IRA. Okay, that's a very important distinction. If you have funds in the 401K or 403B, you don't have them in an IRA at Raymond James, you cannot do a QCD. They're not allowed. So in closing, right now we're rolling up our sleeves, as I mentioned. Myself and many of the financial planners here are financial planning nerds. We love this stuff, and so we're always keeping up on the ever-changing landscape in taxes, financial planning, because these things add value beyond the investment performance that Angie talks so much about. These are things to a large extent that we can control, whether it's proactive tax planning, things like QCDs. Is real money here that unfortunately doesn't flow down to your performance to show you all the great value that we've added, but this is a big piece that we look at when we're helping folks. So more to come on this. If you have specific questions, certainly reach out to your individual planner. We're happy to dive into this in more detail.
I just want to take a second and thank everyone for coming out today, and really thank you for the trust that you place in us. You know, we come in, work hard every day. to continually earn that trust that you place in us. So thank you. This is a great day of the year because you don't always get to meet me or Jacqueline or Nick when you come into the office for your annual meetings with your financial planner. So it's a really great opportunity for you to see some of the team that's doing the work behind the scenes. So we love that you came out today. Thank you very much. A couple of housekeeping items as you're on your way out. We're going to be sticking around to answer any questions that you may have, so feel free to come find us. The 2 sign-up sheets for if you're interested in talking more about the ESG portfolios or the portal sign-up, we've got sheets over on the bar for that, so you can just write your name down and we'll reach out to you about that. And then Jerry also mentioned we have some parting gifts on your way out, so there's some really cool coasters. They're not cheesy, so feel free to take that when you come out today, when you're leaving on your way out. So thank you again.